Ways you can leverage debt to make money. 1. Margin investing. Margin investing allows you to aggressively buy more shares than you could afford. You can make a lot of money if things work out as expected. On the other hand, when things go south, you risk losing it all. This is how it works. If you say you have $10,000 in your brokerage account, you can open a margin account based on your initial investment. With a margin account, you can only put up a maximum of 50% of the cost of a stock. Therefore, if you intend to purchase stock worth $20,000, the brokerage where you have the $10,000 will loan you an extra $10,000 to complete the purchase. If the stock price gains, you can repay the loan and be left with some profit. On the downside, the stock could fall, and if it falls below a particular value, your brokers will make a margin call. Margin calls are demands for additional funds or securities to bring a margin account up to the minimum maintenance margin. If you can't meet up with the required additional funds or securities, your broker may force you to sell assets, no matter the market price, to meet the margin call. 2. Hedge funds. Hedge funds are funds that are typically pooled from high net worth or institutional investors. The fund managers seek high returns with these funds, using unconventional investing strategies. One such tactic is the use of leverage to chase massive gains. They engage in margin trading. That is, leveraging their broker's money to make bigger investments. They also get lines of credit for investing with the hope their gains will exceed the interest. Investing with credit lines uses the same principles as margin investing. But this time, rather than borrowing from the broker, the hedge fund borrows from a third-party lender. Hedge funds are known for making huge returns with leverage. Some are known to lever up to 10 times their total assets. On the downside, if a fund manager miscalculates, they can lose all their investors' capital and go out of business. 3. Leveraged ETFs. Leveraged ETFs are leveraged securities that allow investors and traders to amplify their returns by going long or short on an underlying index, benchmark, or commodity. Using borrowed money, futures, and/or swaps, fund companies let investors multiply returns, as well as losses, by as much as 300%. You can invest in specific bonds, indexes, commodities, or sectors.